Very good.
Hello, ladies and gentlemen, and welcome to our interview with Arthur Petropoulos. Arthur is a founder and managing director at Hillview Partners, which provides M&A, business exit, and capital advisory services for the middle market. So, Arthur, thank you for joining our Risk Management Show podcast today.
That's good to be here, Boris. I appreciate the opportunity. We've listened to some of the podcasts. They're great. And so happy to contribute to the archives.
That's fantastic. So I'm pleased that you like as a professional, so such professional as you like our podcast interviews. So I believe our interview with you will be on the top of the list. So
Let's hope
yeah.
so.
So I believe that we will have a thoughtful conversation on the topic of achieving business resilience in a
Sure.
downturn economy, or perhaps about difficulties and opportunities of owning a business in down economy. So Arthur, before that, could you tell us a short story about your career path, what brought you to where you are right now, and what you guys at Hillview are up to these days?
Sure thing. So I grew up in Providence, Rhode Island area. After law school, spent about a decade in New York in investment banking and private equity, corporate development. So basically helping companies sell themselves, helping companies find capital, as well as being on the other side of the table of providing capital and acquiring businesses. And I think over that duration of time in New York, we saw a particular swath of the market that was underserved, if you will. And so at the very small end of the spectrum, there's business brokers that are selling very small businesses. And then at the larger end of the spectrum, you'd have the Wall Street traditional kind of investment banks and lenders. But in the space that we focus in, so what we define as kind of $1 to $10 million in profit, largely privately held businesses owned by families, entrepreneurs, small groups of investors that don't already have private equity or institutional capital involved. When companies like that look to sell themselves or look to find capital, it's a wildly inefficient process. And so we started Hillview Partners with the idea of mitigating these risks, bringing the timeline in shorter, creating less distraction for owners, making it a more discrete process, making it more proactive versus reactive, and largely, and the most importantly, I think extracting the best results. But that's kind of the story of how we started. And I think like most businesses, you do something enough and you find where someone's underserved, where things are fragmented, where is it inefficient, and where you can optimize it. And that's what we've really built our business around over these last 7 years.
Fantastic. So, Arthur, what is your current assessment of business environment and capital markets in general?
I think, look, you can take it from the perspective that I think some people believe it's gotten worse. From our perspective, it's kind of just reverted back to historical norms in the sense that during the COVID pandemic, whether you can argue the government reacted or overreacted, but there was a tremendous amount of liquidity pumped into the system that effectively pushed interest rates to nothing, borrowing rates to nothing, increased risk tolerance, made the everything bubble start to expand. And I think now gravity still exists, and so what comes up must go down, right? Or what goes up must come down. And so you're seeing a contraction. Now, what I will say is that pain is not felt pro rata across the capital spectrum or businesses. And so I think the early stage companies, the venture capital backed situations, I think they're having a very difficult time securing capital or exits at a value that makes sense. If you just saw Blue Apron was taken public at $2 billion, it was just taken private at 100 million. So, I think a 95% price depreciation or deterioration there. And then at the very large end of the spectrum, for very large companies that were getting crazy valuations, that's come down too. But for the area that we focus in, that's been, the Charlie Munger, Warren Buffett, Benjamin Graham type of steady, consistent, profitable businesses, they don't necessarily go up crazy during the high times, but the benefit of that is that they have a lot of downside protection in the tricky times. And so from our perspective, the most intelligent, there's still a ton of money with private equity and with strategic acquirers to buy companies. The smartest thing they can buy right now are profitable add-ons to their existing portfolio companies. And that's a lot of what we do. So because they're not very leveraged, so they're not interest rate dependent, they're profitable. There's not a lot of binary risk. Does it work or does it not work, right? It's just going to be how well does it work. And so in the space that we function in, it's still very strong. I think what you're seeing is some of the more irrational exuberance continue to wane and in many ways revert back to a level of normalcy, which we don't think is necessarily a bad thing.
Mm-hmm. All right. So Can you start by defining what is downturn economy means? Because we hear a lot of the Fed is reacting and tightening economy, and how it affects business differently, and how can businesses start building resilience and prepare for future economic uncertainties?
Sure. I mean, so, broadly speaking, if we think of a downturn of the economy, we think of it as, the broad definition is a contraction of GDP. That's a difficult thing to gauge. It's a bit of a gauge on the velocity of capital, but from our perspective, I think the easiest way to define it as a diminishing of demand for stuff, right? Whether it's product, services, offerings. And so if you see a broad scale lack of whether it's consumer spending, B2B spending, that's when you start to say, hey, the economy's slowing down or going into a negative kind of downturn situation. And so are we starting to see that? I think less fast does not mean slow. And so what I mean by that is there's a diminishing of demand, but it's still strong. There's still a lot of people out there. Are people buying NFTs and make believe girlfriends or what? Some of the crazy stuff is pulling back, but are companies still buying bricks? Are companies still paying for architectural and engineering services? Are they still paying for specialty consulting, for distribution of pharmaceutical supplies? The machine, the hub of the economy is still moving. So whether we're in a downturn or not, there's definitely a right sizing of sorts taking place. But then pivoting over to what makes your company, I think, durable, or I think that the book that came out was Anti-Fragility, right? And so we think a lot about that is, how do you make your business resilient? The nice thing about businesses in our size range is they benefit from what we call the law of small numbers, which is good in the sense that, let's say the total demand for your industry is $100 billion, and you run a company that makes $10 million in profit a year. Now, maybe you need $50 million of revenue to do that, right? So you're $50 million of revenue out of a $10 billion industry. It's like the demand in the industry can get cut in half, but if you do twice as good of a job, you can still double your business. So point being is, if you're Berkshire Hathaway, if you're Koch Industries, if you're, gigantic companies, Cargill, I think you have to worry about the macroeconomic fluctuations because you're that big. But for companies of our size, it's protect the downside and take advantage of the opportunities, because in the disruptive markets, it's when the opportunities present themselves. So I think it's a twofold thing. Make sure that you're not going to be susceptible to some of the risks that other people are susceptible about. And then at the same time, keep turning over rocks and looking for the opportunities to eat up market share.
Right. Fantastic description. So what are the, suppose that we are kind of, because some are kind of doomsters, they say that we are kind of in depression because a lot of bubble was popping up for the last 20 years. So what are the key challenges and that entrepreneurs and business owners face during downturn, for example? And how can they prepare or navigate through financial difficulties? Because as we remember last time in depression, a lot in New York, there are a lot of people falling from skyscrapers.
Sure. So we've read a lot and we listened to a lot, and we try not to adopt the pure like Nouriel Roubini type of approach of the world, but and my fellow Greek Jim Chanos. But that being said, is that there's always the expression, there's an ounce of truth in every pound of lie. And it's not to imply that they're lying, but even in hyperbole or exaggeration, there are strands of truth. And so a lot of what they're saying is true. But then there's some optimists too, where they might be overly optimistic, but there's some strands of truth in that as well. And so when you think of kind of a company and how do you make yourself most durable to these types of situations, we always break a company down into a framework of 3 items: people, processes, and product. And product can be product, service, or offering. And I think that was a Marcus Lemonis quote. But the digging into each component of that will elucidate or bring to light the risks that you have in a business. And a lot of times risks are emphasized or exacerbated during downturns of the economy. And so what we mean by that is, if you don't have proper IT, compliance, financial, operational, hiring components in place, then if your revenue gets constrained, you're going to have less money to allocate to those things to either solve issues or to prevent against future issues, right? And so I think that's when we talk about in the good times, redeploy capital into kind of buttressing the fortress of the business. I think when you look at a people perspective, again, if there's a diminution of any sort in revenue, you're going to have less opportunity to find people. Now, you also have to look at the upside of it, is that if hiring slows down everywhere, there's going to be talent available for your company too, and maybe at a more reasonable rate. And then I'd say, lastly, think of your product, your service, your offering. Is it equally compelling in a downturn of an economy as it is in an upturn of an economy, right? If your whole, let's just say your business is selling multicolored champagne glasses, right? It's does that tend to sell more in good times? I would think so, right? And so maybe if you're that company, you figure out how to make a glass for a gin and scotch for the sad times, right? But that's a bit of a facetious answer, but the point being is, like, think of your product, think of your service, think of your offering, think of who you're targeting for clients, think of what your customer concentration looks like, and think of their business, right? Because at the end of the day, we're all part of a food chain of some sort. And so think of their situations. And if their situation is going to get worse, you have to assume that there's going to be some trickle up of demand lessening to you. And so how do you prevent against that? And a lot of times the answer is more customers, different customers, more diversified customer base. But those are some of the items that we like to think about, is spot the risk where you can, get ahead of it, you solve it before it's a problem, and then it never becomes a problem.
Mm-hmm. I would like to ask you a personal point of view. What is the largest misconception in your field of business analytics or major acquisitions that you kind of strongly disagree with?
I think that there's a fear with people who are potentially thinking of selling their companies that the company will be entirely disassembled and sold for pieces, or that everybody will get fired. I think that was kind of the common motif, if you will, in the 80s, when you could argue, over bloated conglomerates that were being disassembled in a way and sold into kind of different pieces and right sized from a human capital perspective. But in the modern environment, particularly in the middle market, people are at a premium. Skilled talent is hard to come by. And so if you're selling a business, a large part of the attraction about why someone wants to buy your business is the people, is the capabilities, is the talent, because it's very difficult for them to find. And so many situations, they will require that everybody stay on board, because that is part of the appeal. And so I think one of the misconceptions in the world of private equity, and look, private equity has its shortfalls, and so we're not entirely flocking to their defense, but that being said, I think the misconception in the middle market and lower middle market is that people will be all laid off and that they'll really cannibalize the business. But in reality, I think the people are exceptionally well valued today in a way that gives them even greater opportunity sometimes on a post-transaction basis. And so, like, there's a lot of things we agree with and disagree with, but I think as of late, over this last year or two in particular, that's a theme, and I think a misconception that we've had to talk through a lot of times.
All right, interesting. So because there are specifically, I think as economist, I studied sometimes ago, are there a specific industry or types of businesses that tend to thrive during economic downturns? Because probably people that have to eat or to warm their houses, but what makes them resilient, or what business owners can make based on this? Maybe they have to branch to a new industry. What is your suggestion?
Yeah, I think it's a diversification of the customer base kind of across risk profiles is a big thing that we see. And so if you're only selling to venture-backed pharmaceutical companies, well, if that venture capital dries up for your client, then it's likely that the services that they're going to buy from you may become diminished as well. And so we like to say, finding durable customers, right? So if you think of all of your customers, particularly in a B2B business, what is their durability and what do they look like? And so I think it's digging into the customer side of things. And then I think it's also just digging into, the innovation side of things. Sometimes when things are choppy, it's when maybe people are looking for a value option. Maybe people are looking for a, less of kind of all the bells and whistles. And so there's opportunity for product innovation along the way too. And so I think, again, it's always this combination of defense and offense. So figure out from your customer base, is there anybody that can really harm you? Not in a malicious way, but if you have a 60% customer that's entirely predicated on their next round of venture capital funding, well, you better start thinking about how you can kind of get away or build up so that to kind of decentralize that or kind of take away that overweightedness of that particular customer, and then also keep an eye out for the offensive things as well. But again, it's the same things. It's the people, it's the process, it's the offering, it's the customer base. And from a process standpoint, think of if any of your vendors also have risk, right? If your vendor for a particular component of your business is serving largely customers that have a lot of risk in themselves, you better have a duplication, right? Or a backup or redundancies in all of your vendors as well. And that gets into more kind of the infrastructure of a business, but just like you want to have people cross-trained, you want to have duplications on vendors so that there's no single source in a business. Now, the easiest way to think of that's like manufacturing. If you make, Jell-O pudding, you don't want to be buying milk from one person, right? Because, well, what if something happens to them, right? And you have to restart that. So having multiple sources of getting the services, the products that you need for your business all along the way, I think really does a lot of mitigating of risk. And particularly in choppy waters where vendors come in and they go out as well, you really have to kind of look for every weak point along the whole food chain of what you do.
So let's discuss about metrics or KPI. So what are you as a kind of business buyer or seller look for at the company?
Yeah, so I think buyers will value a company. So we can talk about the metrics in terms of acquisitions in particular. A lot of times we say companies sell for three reasons: the fundamentals of the business, the access that the business has to a particular end market or geography, and lastly, the capabilities or aptitude. And so if you think of a down market, usually a company, if based just on the fundamentals, will acquire a company just on what they call a multiple of pre-tax profit. So that's a metric. And so if you think of a company that makes $2 million in pre-tax profit, maybe that multiple is somewhere between 5 and 8 times, that EBITDA range. And then as EBITDA grows or pre-tax profit grows, that multiple expands as well. And that's largely the thesis of a lot of private equity, is kind of aggregating businesses to grow EBITDA to enhance the multiple. But that being said, you think of so if you think that all of the large companies are trying to mitigate their risk at the same time, how are they thinking about it, right? They're saying the same thing. How do we diversify customer base? How do we get new innovative ideas, right? And oftentimes the acquisition of the business is a way of accomplishing that in a way that de-risks it to them, where they pay a dollar amount, but they don't have to worry about the outlay of resources, the time, the things like that. And so from our perspective, if we can find a situation where our client is the missing puzzle piece to a larger client situation, well, then there's a lot of value there, and then you start to really enhance the multiple that will be paid. So that's it on the acquisition side. I'd say digging into a company side of things, we want to look at metrics to look at our revenue growth. And so not just this past year, but what's the revenue growth been over the last 5 years, the last 10 years if possible? How durable was that revenue during COVID? It's a bit of an anomaly, but to see how shock waves kind of shake something or do not has an impact on the discussion. We then want to look at unit economics or gross margin on a situation. So, right, like you could have, Boris's $10 bill company where you sell $10 bills for $8, and you could have an infinite amount of revenue, but there's no unit economics, there's no positive contribution. And so we can look at a company, and then even if it's not terribly profitable on a net income basis, if the gross margin on their service or offering is 50, 60, 40%, then that still has a lot of value to somebody that may be able to buy it purely on that kind of gross profit. And then going down to the EBITDA or the pre-tax profit, we want to see an EBITDA margin that is growing at a faster rate than revenue, because what that means is that there's operating leverage. And so effectively, if you think of a business, let's say you manufacture pencils, you buy the wood, You make the pencils. Let's say there's a 50% profit margin on all of the pencils that you make, right? That's your gross profit, your COGS, and it will effectively just track, the amount of sales. And look, over time, maybe if you're buying more wood, you can get a better price, but let's just take that assumption. But then you have the operating expenses of the business, which is the kind of the core nucleus of expenses. And that's your back office, that's your marketing spend, all these things. And some of those are going to be variable and grow with revenue, but many of them are going to be fixed. And so if you can keep getting revenues coming in and growing revenues while controlling operating expenses, you can grow the EBITDA margin. And so we have a customer working now in the building materials, or client working in the building materials space, that has grown revenue by 20%, but they have doubled the EBITDA margin. And so that means profit itself has grown by 40%, right? And so point being is, if you can double the margin of EBITDA as you double revenue, you will quadruple the profitability of the business. And so in any event, we've been able to focus on those metrics within a company. So I think there's internal and external. You're going to have the metrics that you dig into specific to the company and how to optimize it, or how to look at the track record and see that it has been optimized in many ways. And then secondly, you'll look at the metrics relative to the transaction and how EBITDA is valued and on a multiples basis. And then what are the factors that can enhance that or bring that even higher?
Fantastic. Yeah, this is good, because I know, as a business owner myself, I know that a slight increase in margins of every metric, it actually multiplies your performance.
You know what? If you actually look at certain sports, say like long distance running or swimming or cyclists, so not sports where it's like you can do a very acute action, but it's just a long kind of a slog of a competition. The things that they train can just be, how do you get 3 more pedals every minute on a bike? How do you keep your foot on the ground for a fraction of a second more during a marathon? And so you're right, it's the aggregate effects of many, many small changes that create a materially different outcome, for good or bad. But in our situations, we're always looking for the good.
Yeah, fantastic. So I believe that we can discuss these issues many more hours, and hopefully we can do another episode with you guys, or with you personally, because there are a lot of topics that we can discuss. But for the first discussion, maybe we can, if we summarize this discussion for someone who is listening to this and would like to walk away with 1 or 2 major takeaways, what would it be?
I'd say hope for the best and prepare for the worst. And we don't mean that negatively, but you have to have faith in God and business. But at the same time, I think it was a Vince Lombardi quote where he said, hope is not a strategy. And so you have to do all of the right things, and you can't control the outputs, but you can control the inputs. And so you must be doing all the right things to grow a business, but you also must look at all of your risk. And do you have an Achilles heel? Is there a weak point within the business? Because as they say, life breaks you at your weakest link, and business is not that different. It's not going to be, the thing that super well, that you're all over, that you're on top of. It's going to be that thing that you go, oh yeah, we'll get to that. We'll fix that problem. We'll sort that out. That's where, the water gets into the foundation. So I think as we're entering choppier waters, or as we're entering a more, you can call it challenging or opportunistic, it's both sides of the same coin situation, I do think that it's good to do all of the inputs, do all of the iterations necessary to grow the business, to do the right things there to expand, but at the same time, take a very close and critical look at your own business, at every element of it. Again, people, process, offering. Where are their weak points? Where are their deficiencies? Where can the tide going out expose you? And I think that's important to kind of get in order. So it's always this duality in business, that we are charging forward, but protecting what we already have. And I think particularly in more challenging or opportunistic markets, that's important. So that's the thought we would leave everybody with. There's a lot of opportunity out there, but always keep an eye on the risk and mitigating it where possible.
Fantastic, Arthur. That's all my question. Perhaps if I forgot to ask you something that you feel is important for our audience, please go ahead.
Oh, look, I think this is pretty comprehensive. I appreciate it, Boris. I tell anybody, if they're interested in learning more about our firm, check out our LinkedIn page, Hillview Partners, or my own. Check out our YouTube channel. We put out 2 videos a week, kind of just talking about a different topic or subject matter relative to business sales, relative to finding capital, just general operationally optimizing a business and other topics. And so check it out there. And we're always happy to chat with people if they have the idea of selling the business either now or just have a conversation for things down the track. So, but no, I think we covered a lot here. I agree. We could chat for a very long time on our theories of the economy, but I think this is a good first installment at the very least.
Yeah, fantastic. Thank you again. I wish you great success with your company. And I also watched your videos. Actually, they're actually very small chunks of good, apprehensible videos for specific topics. So you do a good job of explaining people what to do.
Oh, I appreciate that, Boris. That's helpful. I appreciate the opportunity to be here. It's a great conversation. Look forward to chatting again sometime.
Absolutely. Thank you again. Bye-bye, Arthur. Stop.